Well, hi everyone, Sean Humphreys here. I trust this screencast video finds you doing well. Well, wars, rumors of wars. It's part of human history, and we're going through that period right now. So will Russia invade Ukraine? We don't know for sure whether that's going to happen or not, but it is all over the news. So I think this is a good opportunity to revisit what's happened in the past as it relates to geopolitical events, wars, rumors of wars, and surprise shocks that then impact economies and markets potentially. So the past is very instructive about how we should handle these kinds of events as it relates to our finances and our portfolios. We're going to take a look at the past and then talk about how you should handle any volatility that might take place as a result of the current skirmishes that might be going on between the Ukraine and Russia. There's been minor skirmishes that have been going on for a while, but we haven't gotten a lot of news about it. But now this may be a more significant incursion. So let's go through it. We're going to talk about the history, and this is important information because it's designed to counterbalance all the raging craziness in the media. They know that they get your attention when they can create and stoke fear and anxiety, and that's what they're doing right now. So let's take a look at the history. Before we do that, I want to go through and define for you what we mean by geopolitical events. So let's first of all just define quickly what a geopolitical event would be. Let's look at a few examples. So one example would be trade wars. So if you look at tariffs being levied against another country, when you saw the sort of the tariff battles between the Trump administration and China, that would be an example. It can lead to political instability, and then it could ripple into economic instability. And in the short term, markets can respond negatively to those kinds of things. Another example will be, of course, what's going on with Russia and the Ukraine. So again, if there's an incursion into Ukraine that's significant, it creates short-term drawdowns in the market, instability, market instability. You could see OPEC initiate an oil embargo. So they cut supply, bid up the price of oil. It creates economic instability, and that potentially can create wars even, depending on how bad it gets. You can have North Korea launching missiles on a regular basis. That could create some political instability and concern around the world. So those are just, and terrorism strikes would be another example. So those are some of the things that can impact the market. Now, the one thing that all those events have in common, at least initially, is that they're not true underlying economic or market events as it relates to stock profitability, companies' earnings, that kind of thing. It takes a while for those things to begin manifesting themselves in the real economy. And that's why, generally speaking, geopolitical events have very short-term impacts on the market. So let's take a look at a few examples. So this is a really good chart that summarizes, allows us to step back and look at past geopolitical events, and it informs us as to what typically happens. The chart's titled, Most Geopolitical Events Have Limited Market Impact, and it looked at the start of the Korean War, Lockerbie bombing, Cuban Missile Crisis, 9/11, Beirut bombing, and the downing of MH17 back in 2014. So they're looking at the S&P 500, so the bellwether stock index in the United States. And when we look at this, here's the major instruction that it provides us. The majority of individual major events ranging from the assassination of Archduke Ferdinand 100 years ago through to 9/11 and recent events in Iraq and Ukraine impact major stock markets by around 10% or less, with the effect being fully reversed within a month or so. Okay, so generally speaking, that's what's happening on this chart. On the bottom of the chart here, you've got days, day 1 through to day 61, and you find that the majority of this volatility here, so we definitely have volatility post-event, but within about a month, most of that volatility has been recovered. Okay, so the markets are back to baseline where they were prior to the volatility hitting. There are some exceptions. A good example would be the Korean War, and at about the 2-month mark, it was still kind of trending below baseline, but it recovered quite a bit over that time period. So what's a major suggestion from this data? This suggests that investors should look beyond short-term market turbulence and refrain from selling after such incidents. In fact, when you see volatility like this, it's very important to remind ourselves that this is not normal economics, the economy, stocks reflecting, their earnings and profitability and hopefully doing well, and those stocks going up. So this is something that imposes itself short term on the real economy, but is usually short-lived because the planet goes back to living its life again, right? Going back to work, the real economy begins to become the prominent thing that markets tend to cue off of, not these events. And that's why they generally recover relatively quickly. So number one, when it comes to portfolio planning, it's important to be playing the laws of probability. A low probability decision is to sell post one of these events. The high probability of position is to make sure you hold your high quality investments, potentially add more money through that volatility, and expect recovery and a decent return through that period of time. Now, many of you have asset allocation services that will rebalance for you. So when you see downside in the stock market, money will get shifted from cash or bonds to take advantage of that opportunity. So that chart really is critical. It tells you that there's opportunity embedded in the volatility, and we shouldn't be too concerned. I mean, obviously these are challenging times when we go through them, but ultimately the response should be hold if you've got quality, reasonably good diversification, and on that part of the portfolio, if it's not needed right away, you just wait for the recovery and maybe even add more money at that point. Now, this is a great article from Schroders.com. It was titled, How Does Geopolitics Impact Investment Returns and What Can You Do About It? And I thought there's a few points in this article that, again, underscored some of the things I've just been talking about. But it really gets down to at the portfolio level, what are the impacts? Now, obviously, how does it affect markets? So we've alluded to it already, but what typically happens, even though I'm instructing you, recommending that you don't sell your stock assets when you go through this kind of volatility, and our clients are extremely disciplined through market volatility because they understand the basics around that topic. But obviously, many investors do. You wouldn't see the markets drop unless there's people selling. So there's two components to the market we always have to think about. There are people long in the market who are longer-term investors. They're not traders. And then you have traders or speculators. And those are the investors that often get pushed out of the market during that period of short-term volatility. But you also have some people that are panicking. They'll move money from the stock market to cash, to other currencies, to bonds, and you see this repositioning of portfolios. So this is a really good example, kind of to bring it home for us. This is the cumulative returns during reaction to geopolitical events, and this chart shows you the Gulf War, 9/11, and the Iraq War, the different time periods here. And you can see the S&P 500, which is the U.S. stock market, global markets, the MSCI, gold, tangible asset, and bonds. And you can see that with the Gulf War, that at its height went from August 1990 to February 1991. The U.S. stock market was down minus 14.2%, global markets down minus 9.6%, gold was up 6.4%, and U.S. 10-year bonds were up 1.9%. If we go to 9/11, you can see again the markets were down minus 14%, global markets about the same, gold up, and U.S. bonds up 4.1%. Okay, so you can see, not surprisingly, how each of these asset classes responded. Now, this is an interesting chart because it takes a look at the same market cycles, but it looks at a safe portfolio, which would be basically cash, currencies, and bonds, a risky portfolio, which would be all stocks, and then a 60-40 portfolio, which would be 60% stocks, 40% bonds. So again, if I go to the Gulf War, the length of that was 7 months. The return range for a safe portfolio is about 8.2% percentage change. For a riskier growth portfolio is minus 6.3%. And on a 60-40 mix or balanced portfolio, basically break even, pretty close to break even. Look at 9/11, 22 months in duration, 18.4% for a safe portfolio, so the bond market rallied quite significantly. And you've got a minus 16 for a stock portfolio, and a 60-40 portfolio is minus 2.2. If we go to the Crimea and ISIS, and this is actually, the whole Crimea thing is kind of timely because that gets back to the whole Russia-Ukraine issue that's going on right now. It's kind of tied to that. 6 months in duration, 1.8 up for a safe portfolio, 4%. So it wasn't a loss, but a risky portfolio was up 4% at the end of that time period, and a 60-40 portfolio was 3.1 to the positive. So how should you look at that particular chart? Well, again, for many of our clients, they do have equities in the portfolio. And so we have equities or stocks in the portfolio because we need to drive higher returns than what cash or cash equivalents are going to give them. The other thing that I often talk about is that you can't time the market. It's so easy to miss a lot of the growth in equities because the growth takes place over very short periods of time. We've done other videos that talks about you can't time the market given the short bursts and the relatively small number of days in the market that drive most of the performance. So the way that you deal with it is you can see that if we need money in the stock market, and most clients do, most investors do need some money in growth or equities, you can see that the balanced portfolio weathered this volatility quite well. The other thing that would be important is that the investor does not sell at the bottom of that market volatility through a geopolitical event, ideally even adds money at that point, and likely will have, with our clients, likely have a rebalancing service that will help them to add more money automatically when you see market volatility. So that basically summarizes my short little discussion on market volatility. We live during crazy uncertain times. That's certainly been the case. We've seen lots of events over the last 2 years that have created anxiety for good reason. And this current issue creates anxiety and concern as well. But it's my hope that this video will help you to frame it in the proper perspective as it relates to your portfolio. Again, if you have any questions, don't hesitate to reach out to our office. You take care. Bye-bye.